In an op-ed last month, the founder of FTV Capital wrote that the IPO window isn't closed, it's broken. He added that the public market is markedly failing to meet the needs of today's high-growth businesses, creating a growing vacuum that private markets writ large are filling. Joining us now is Brad Bernstein, the author of that report. It's an interesting time to write this kind of report because we, of course, are seeing IPOs come back. So why do you feel the IPO market is then broken?
So, thanks, Sonali. You know, when I look at the market, it's not about whether companies can get public. The question is, how are they thriving once they're public? And let's look at the broader ecosystem. Over the last 20 years, we've gone from over 8,000 public companies to under 4,000 at a time when there's been so much innovation that you would expect there to be 15 or 20,000 companies. So I get to see all these exciting, dynamic companies in the private market. And time and again, I'm seeing that entrepreneurs aren't choosing or talking about wanting to run a public company, and that concerns me.
What are the challenges that they're presented with at this point? Why don't they want to go public?
Great question. So I think what we're seeing is that the cost of being public is very significant. And so particularly for smaller growth companies, companies that maybe are less than 10 billion of value, you're going to spend at least $10 million as a public company between your auditing fees, your legal fees, your compliance costs, your D&O insurance, your compensation consultants, your independent board members. And none one of these things is unreasonable, but when you add up the cumulative effect, it's death by 1,000 cuts, and it really makes the job of a public CEO quite burdensome.
Well, it's interesting because you are operating here in the growth investing industry. You look at the companies that are supposed to be the companies of tomorrow. So if there is an issue with how they go public, then what is the choice left for investors here?
Absolutely. I mean, the truth is this dynamic is great for my business. We as a growth equity investment firm are seeing huge opportunities to invest in the private market. And for institutional investors, there's fantastic opportunities. What we're seeing now is more and more retail investors are being tempted into growth and buyout private equity funds as a way to access these companies, but they are signing up for illiquidity that really is better suited to institutional investors.
And Brad, I can see the opportunity here, more opportunity being created in investing in private markets, but what about the exit opportunities? If the IPO market isn't attractive to certain people, then how do you find returns for investors?
Absolutely. So we're very fortunate. If you think about the markets as a food chain, we play in that middle of the market where we're able to sell to larger funds and strategic buyers. But right now, the concern is what's going to happen to these larger funds who need access at the top of the food chain to these public markets. And if we don't have a liquid, successful public market, at some point, it's going to cascade down the food chain and create an unhealthy dynamic because everybody needs to get liquidity. So in the near term, firms like FTV are particularly well positioned. We're seeing great opportunities and we still have buyers. But long term, this is an unhealthy dynamic which really needs to be addressed. And at the same time, strategic buyers are also under pressure from the FTC and other regulatory bodies around the world, all of which is having an impact on M&A. So all of these things have to be working for our capital markets to be successful.
And it's interesting, too. You're kind of speaking to this kind of clog in the system that certainly the large private equity firms with big existing holdings are certainly feeling. It's interesting. Blackstone is one of the investors in FTV. They have their own growth business. Certainly you and they feel like this is an interesting and important space right now. What is the opportunity as you see it right now? Where are you putting new money to work?
So interestingly, just following up on your conversation about the private debt market, which has now become a $1.7 trillion market, the growth small cap market is equally being moved into the private alternatives market. And the beautiful thing is that it's a market like Baskin-Robbins. We have many flavors of ice cream. There are many types of investors who do minority deals, control deals, leverage deals, unlevered deals, venture, obviously. And obviously, where we sit in growth, we're seeing all sorts of companies that grew up out of the venture industry are now ready for that next level of maturity, scale, and an owner who can help them to execute from there. So we're thrilled with the opportunities we're seeing, and we think this will be a multi-trillion-dollar market, just like private credit. But we also think that we need to make sure the public opportunity is there as well.
So one problem for a lot of these exit opportunities, we've been talking about it a lot in private equity, it's cost of financing. But for venture especially, it is that IPO market. It's exiting, it's valuations. Where does the valuation story stand as you see it today?
Absolutely. Well, I think it's back to fundamentals. So I think obviously in 2021, we got to a point of euphoria. It was growth at all costs. Venture folks were leaning in extremely hard. There was no discipline around profitability. And obviously through 22 and 23, that is something that has really been a major pivot back to more rational valuations. Fortunately, that's something we've been committed to long term. But I think what we're going to see is that discipline will continue. Many public investors who got burned in 2021 have also brought their expectations in line and are looking more for those rule of 40 type companies that have a good balance between profitability and growth. That's what we're seeing. But to your point, the lower the valuations in the public market, that has to trickle down to the valuations that venture capitalists can pay, growth investors can pay, buyout firms can pay.
But it's interesting, the valuations in public markets, you're seeing stocks at all-time highs, but is that just not true for everybody?
It's so narrow. If you look at small cap has really not seen the kind of valuation expansion that we've seen in the Magnificent Seven and top tech names. And what's happened is the ETF, the indexes that are so market-based and market-weighted really lean towards all the money going to the large cap names. So we've got to figure out a way to widen out the participation and see that valuation uplift into the small cap. And I think that will obviously be important to get to the public IPO market taking off. Of course, we still have to address these other challenges and make it more successful for founders to operate in a public environment.